DocuSign reported quarterly financial results that disappointed stock market investors, and the stock price fell by roughly 20% following the earnings announcement. Of course, I'm disappointed in that because I've rated DocuSign stock as a buy, and I've had the stock rated as a buy all year long in 2025. Unfortunately, DocuSign stock is down over 12% year to date in 2025, even though it's up roughly 5% as of intraday market trading on Monday, June 9th, 2025. I'm going to review DocuSign's quarterly earnings results in this video and update my buy recommendation and let you know if I still think this stock is a buy here following the earnings release. I'll share with you my proprietary discounted cash flow valuation model so you could see what I calculated as a fair value for DocuSign stock today. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So as a reminder, here is my buy recommendation for DocuSign stock, and I last updated that on May 23rd, 2025, reiterating the fact that I like this stock as a buy. As you can see, I keep track of all of my recommendations and I revisit them and keep myself accountable. I don't just share with you those stocks, those picks that have worked well, like other YouTubers who are still dwelling on the fact that they recommended Tesla stock back in 2017 as their one claim to fame. I go back and I revisit all of my recommendations and I share with you all of the ones that I've gotten wrong as well as the ones that I've gotten right. The whole point that I try to emphasize here is I provide information to help you make decisions. I don't try to act like I know what's going to happen in the future. I just conduct my research, follow a process, and if it works well, great, I'm pleased with that result. And if it doesn't work well, I learn from that and I share with you the learning experience and we try to improve and move forward. So DocuSign, unfortunately, is one of the recommendations that hasn't worked so well this year, but let's see if we still like this stock given the updated information. So DocuSign reported revenue of $764 million, which was an 8% increase year over year. Now that number wasn't all that bad. That's not what caused the share price to fall. What caused the share price to fall is billings, which came in at $740 million, which was only up 4% year over year. You might be curious, what are billings compared to revenue? Well, billings are contracts that DocuSign signs that eventually turn into revenue. So you might sign a contract with the university, like with the university that I work at, and you then convert that into revenue as you perform that obligation. The university might sign a contract for 100 e-signatures, right? And those 100 e-signatures eventually turn into revenue as the university uses those signatures up. So the reason investors were disappointed in that number is because they were expecting a much larger billings number. The company said that the reason the billings number came in lower than expected is because they were converting to a new product that more emphasizes artificial intelligence, and the transition happened sooner than expected, which resulted in a decrease in billings. But the management team reiterated to investors that they expect this category, the billings growth, to return to larger numbers relatively soon. And longer term, e-signatures, in my opinion, will grow for decades. I don't expect 100% of signatures will turn into electronic signatures, but I do expect roughly 90% of signatures worldwide will be electronic signatures, a much larger percentage of signatures that are happening electronically today. It's just so much more convenient for both sides of the transaction to have signatures electronically rather than in person. I know at the university, we do electronic signatures. I sign my contracts electronically, and most of my contracts I sign electronically. It's so much more convenient. I would be less inclined to sign a deal with any counterparty if I had to do it in person, because it would take hours out of my day to do it in person compared to doing it electronically. So if I'm signing a contract in person, and the other side of the transaction is insisting that the transaction be signed in person, I'm going to request a larger payment in return for having to do that in person compared to another company which is willing to sign the contract electronically. So, unless you want to face that competitive disadvantage, you'll have to do electronic signatures. And so, I think longer term, this category will continue growing. DocuSign is the largest player in this industry, so it'll benefit from that tailwind. But overall, the industry is not a big industry, right? The total spending annually on electronic signatures is less than $100 billion. And if you compare that with other industries like advertising or home improvement, those are $1 trillion industries. So this is a relatively small industry. And the reason why I point that out is because competition. Some investors are concerned that DocuSign could face competition from a bigger player who enters the industry to take that market share. And one of the reasons why some of the bigger players won't enter the industry is because it's just not worth it. It's a relatively small industry with an entrenched rival in DocuSign. Why spend all that money and energy and resource to try and take that market share? If anything, they can just, if a big player wants to enter this industry, I think it would be more reasonable to just acquire DocuSign, to try and acquire DocuSign, which is a pure play electronic signature company, and plug that into their existing business. So that's how I feel about DocuSign's competitive pressure from a big player longer term. Earnings per share for the most recent quarter increased more than doubled to 34 cents a share, up from 16 cents a share in the same quarter last year. Cash flow from operations was a little disappointing at $251.4 million compared to $254.8 million in the same period last year. This can also be attributed to the lack of billings growth, because when you compare year over year, sometimes these billings come with down payments and payments up front. And when your billings are not increasing by that much compared to a period last year when they were increasing, you get a smaller cash flow from operations, similar to free cash flow at $228 million compared with $232 million the same time last year. More importantly, however, is the company's cash flow to sales ratio, which is robust. Roughly 1/3 of its revenue turns into cash flow because it's already invested in the technology and it doesn't need to reinvest all that much money into the business. It has a pristine balance sheet with $1.1 billion in cash. And because it has an asset-light business model now and the cash needs of the business have been significantly reduced, it can return a lot of that capital to shareholders. And it repurchased $183 million of its shares in the most recent quarter compared to $149 million in the same period last year. The company also increased the authorization for the share buyback up to $1 billion. Increased it by $1 billion in the most recent announcement. So looking ahead, the company is forecasting $779 million in revenue and $762 million of billings, both at the midpoint compared to the bottom and the higher end of the update. The billings number of $762 million would be a nice increase from the current billings number of $740 million they reported in the current quarter. Though I calculated a proprietary discounted cash flow valuation model for DocuSign stock, and the valuation I came to is $99.98 for this stock. Current market price is $78.88. And so there is significant upside here for DocuSign stock at the current valuation. And when I go to finchat.io to retrieve the forward price to earnings ratio, it's trading at a forward PE of 21.75. So whether I look at the valuation on a forward PE basis or whether I look at valuation on my DCF basis, DocuSign stock looks undervalued. By the way, you can get a 15% discount for using my link in the description for DocuSign, for FinChat, I should say. So what do I think of DocuSign stock following the earnings release? So the billings decrease or deceleration was disappointing, to be sure, but overall, I'm still bullish on this company longer term. And near term, there might be some headwinds, but structurally, I didn't see anything that makes me pessimistic on DocuSign stock. So to update this recommendation, I still like this stock and I have it rated as a buy. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.